Good day, fellow investors. Suggestion on my research platform from Castrogan was to analyze, apart from other stocks that we mostly covered, Coupang, e-commerce in Korea, and big stake in Druckenmiller's portfolio. Just a note here, I think this is the best time to join my research platform because we have 4 stocks to buy now, so check that out in the link in the description below. But let's go to Coupang, and since going public, the stock is down 66%. The market cap is now 28 billion and the P/E ratio is 66. And I want to share here 3 things that we can learn from this growth stock, recent IPO, very interesting business. Those 3 things are: don't give trust to 13F reports on what and how someone owns something, do your own research, and see how that fits you at that price. Then there is the complexity of investing in a growth story, and of course the risk and reward in this case for Coupang investing. Let's start immediately with Druckenmiller. One of the best investors out there, Druckenmiller, owns Coupang, and you see, okay, if he owns it, well, then it must be something also for me. However, you must not get confused when you look at these sites. They say that he bought at IPO. No. If you look at data, they bought in the first rounds when these companies were not public, years before the IPO, for pennies on the dollar that you pay for the 4.6 billion 2021 IPO. And that's something that we as retail investors cannot do, but have to understand when it comes to investing. So we have to do our own analysis and see at what price something fits you. Of course, you can't go to South Korea and buy 10% stake in some e-commerce thing. For that, you need to be Stanley Druckenmiller or Bill Ackman. Similarly, the story with Palantir. Druckenmiller is one of the biggest investors there, but he bought first in 2011 when no one of us even knew Palantir existed. The next thing to discuss is the complexity of investing into a growth story, which Coupang is. We see here extremely fast growth, doubling every year, especially with the pandemic, but now we have the first big slowdown with low teen growth rates, which is not what investors have been used in the past, and that leads to a lot of consequences. I've looked a little bit at the conference call. They are now trying to find more growth in Taiwan. They say that there is still a lot of margin expansion to increase profitability, and that their cash flows are in line with EBITDA, a little bit higher now because of working capital changes, but will be in line with EBITDA at 1 billion now. And now, if you look at the conference call, there is always something there that is the key. And this question was asked by Barclays about the competition, AliExpress appearing to be more aggressive in the country, and can you discuss how that works for you. And the discussion there with the CEO was that they work on the wow element of whatever they do. And I wasn't convinced as, okay, I'm going to invest in something that has a wow element and that is the competitive advantage against others. And then no matter in what world you operate, in the wow or not, if there is a competitor, your margins will get thinner. And if that competitor can work cheaper, better, faster, on a bigger scale than you have, then you know your margins might not go that far. And then there is also reinvesting all the cash flows into growth and stories like that. And then the key question is, when will I see the rewards of this and whether will I ever see them? And the key is that hot stocks always slow down sooner or later. I've discussed this 4 years ago, 2019, when I analyzed Visa, where we discussed the delta of the delta tool, and that's a video you must watch if you want to understand how to invest in growth stocks. Because, as I said, those slow down, which leads to a normal valuation. For example, we now have Coupang, and if we give it a normal valuation at free cash flows that they discuss, then P ratio 15, they should be making 2 billion. But I want to make money on Coupang, so I want to see the market cap go from 30 to 60 billion in, let's say, 3-4 years, so that I double my money. That would be the minimum required return from someone investing in Coupang. So if I want to see Coupang double, the stock double, they need to bring their profits to 4 billion. So from 1 billion to 4 billion at a normal P ratio of 15 for a big company, they need to quadruple their profits, they need to triple their revenues on current margins, or at least double. And will that happen in 4 years? I find that unlikely, and therefore the risk and reward is still very, very risky. And there are many of these stories that are unfolding. Some are looking better, some are looking less better, but you need to understand why you own something and not just buy something because Druckenmiller owns it. In this case, Coupang is still risky, there is still room for downside, but there is still room for total disaster if they can't keep margins up, etc., etc. Many of these e-commerce stories are like that. So created on a boom, found a niche that works, and then tried to expand in other countries where the niche might not work that well. And that is high risk, potentially high reward investing. But at 30 billion, I don't know how big the reward could be, because it needs to go to 60, 90, and the e-commerce boom mania of 2021 has unfortunately passed. Thanks for watching. Hope you learned something. Check what I do on my research platform, and I'll see you in the next video.